Good day. I'm Martin Gagel with Market Radius Research. It is Thursday, June the 23rd, and we've got CEO Brad Douville of Greenlane joining us. Greenlane is a leading global provider of biogas upgrading systems to generate renewable natural gas from organic waste sources. It's great to have Brad and Greenlane back for an overview and update. The green tech investors have had a hard time over the past 12 months. Well, clearly the markets, including the green tech space, were ahead of themselves back in early 2021. The market has maybe gone a little overboard since then, as many companies are trading well near their 52-week lows. I'm trying to figure out whether the market reaction aligns with business fundamentals and to see what sort of opportunities are here for investors at current prices. Greenlane is a global leader in the RNG space, and I am looking forward to understanding the current business environment for Greenlane. But please remember, this is not a recommendation nor investment advice. We're here to learn about the company. Brad, thank you very much for taking the time to give us an update here. And why don't we first go over the presentation deck to get a quick update or an overview on Greenlane.
Yeah, absolutely. Thanks for having us back, Martin, and excited to be here. And maybe a bit of a spoiler alert, the business fundamentals are strong. So
well, let's just wrap it up then. We can call it quits now.
Let me get into it. As to all the things that were driving the market enthusiasm 12 to 18 months ago are continuing. I won't go through this slide, but obviously I'll be making some forward-looking statements, so caution. So at our core, what are we focused on? We're focused on the ongoing climate crisis, specifically decarbonizing large and difficult to decarbonize energy systems. And those are the natural gas grid and commercial transportation. That's our mission. That's what we're up to. That's what our systems do. And we do that, think of renewable natural gas is to the natural gas grid, as wind and solar are to the electricity grid, all about decarbonization. And RNG is a drop-in replacement for fossil natural gas. It's chemically identical, but it's either carbon neutral or carbon negative in some cases. So carbon negative, of course, being equivalent to removing carbon from the atmosphere, and I'll talk about that. So what do we do? What do we do as Greenlane? We are a market leader globally of the technology of the systems that do this biogas upgrading process. Our systems produce clean, low carbon, carbon negative, renewable natural gas from all sorts of waste sources, whether it be landfills, wastewater treatment plants, farm applications, or food waste streams. And the resulting product, it's suitable for injection directly into the gas grid or direct use as a vehicle fuel. I'll just give a few overview highlights of the company. We've been growing extremely rapidly. We had record revenue last year in fiscal 21. Our fiscal year is the calendar year. So that's record revenue, 55 million. All numbers are in Canadian. That was an increase of 146% over the prior year. 6 consecutive quarters of positive adjusted EBITDA. We've completed our first M&A transaction in February. And I say first, Greenlane as a company has been around for over 3 decades. However, we went public in the middle of 2019 as a pure play in the renewable natural gas space. And so when I refer to this first, it's from that point in time since going public. We are the largest in the space from the biogas upgrading perspective. Over 135 biogas upgrading systems sold in 19 countries. 12 of those countries, we were the first to provide an upgrader. Which if you think about a company like Greenlane being around for 30 years, when the end markets haven't really been around for then, Greenlane's been a real pioneer over time. However, the market really took off over the last couple of years. We've seen that reflected in our rapid revenue growth. And that is indicative of this industry being in the very early setting of embracing renewable natural gas and what it can do. Again, think of what wind and solar has done in the electricity grid over the last couple of decades. We're in the RNG industry maybe 15 years behind wind and solar. So it's just, it's getting embraced and adopted very quickly. And I'll talk about some of those underlying drivers. Our sales order backlog is strong. as of the last quarter that we reported as of March 31st, 36 million. Our sales pipeline, which is our opportunity set, 900 million of opportunity. The core business of system sales, healthy gross margins. We've expanded into recurring revenue and profits model through our deployment of development capital. We announced our first deal just a couple of weeks ago. I'll explain that and what we're up to. We have a strong IP portfolio, and we are unique in the space. Not only are we a pure play, all entirely focused on renewable natural gas, but we are the only biogas upgrading company that offers the three main biogas upgrading technologies. I'll explain that. We're looking at a total addressable market opportunity of 90 billion in biogas upgrading sales. So the overall investment for biogas projects more generally is much larger than that. The 90 billion specific to our core business of system sales. And the market drivers are demand from governments, utilities, corporations, consumers, all looking for low carbon and carbon negative, specifically for decarbonizing these difficult to decarbonize sectors of the gas grid and commercial transportation. So visual is always helpful. So let's look at this. On the right-hand side of the slide, we have the end markets, the gas grid, commercial vehicles. Typically, the commercial vehicles would draw from the gas grid. So in today's world, it's pretty much always we inject the resulting product into the gas grid, either directly or by way of a virtual pipeline, which means you compress and haul or liquefy and haul to the point of use. On the left-hand side of the slide, we have the typical waste sources. Landfills and wastewater treatment plant are, of course, ubiquitous in all municipalities. These are waste problems that we're turning into opportunities. We have food waste streams that in some jurisdictions, there's mandates in place to divert this organic matter away from landfills. That has to go somewhere, and it's an excellent feedstock for producing renewable natural gas. We have crop residues, and we have ultra low carbon negative RNG coming from sources like dairy manure, swine manure. So this is where you avoid raw methane from escaping into the environment. Raw methane is 25 times the greenhouse warming potential of carbon dioxide. So that's what makes, if you're able to capture that before it gets released into the atmosphere, you get carbon negative projects of 3 or 4 or 5 times that of carbon neutral. So it's highly attractive. We do the thing in the middle there, the upgrading. So once it's converted from biomass into biogas through either the landfill or a digester, which is a big steel or concrete vessel. Once it comes into biogas, which the decomposing organic matter turns into biogas in an oxygen-free environment, we come in, we cleanse it from impurities like hydrogen sulfide, volatile organic compounds, and then we separate the bulk of the remainder, which is carbon dioxide and biomethane. Called biomethane because it all comes from biosources, and that's the process. So we need high purity biomethane. It's chemically identical to the fossil variant, but it's either carbon neutral or carbon negative, which therein lies the value. You're really paying for, yes, you get the physical commodity value, the same as Henry Hub or whatever the trading price is in the jurisdiction, but the key value of renewable natural gas is the environmental attribute associated with its carbon reduction. So we can see for, say a landfill project in the United States, that might fetch, say, $25 or $30 US per MMBTU of renewable natural gas. If it's a dairy manure project that's highly carbon negative, that might be worth $100 US per MMBTU. Of course, comparing to Henry Hub in the order of $5 ish right now. So that's the kind of value that we're talking about when it comes to decarbonizing these systems.
Brad, sorry, can you just flip back to the prior slide? You said the different value, and is that different value given from the the highly decarbonizing from manure and so forth? Is that from carbon credit markets where the additional value is added on, or how does that extra value get sort of monetized or
Yeah, so you're jumping ahead,
Oh,
Martin, but
okay.
that's just fine. So that's a great question, and I often touch on it on that slide. But let me give a bit more detail here on this slide. So think of those two different markets as different sectors. So commercial transportation and the gas grid, they operate somewhat differently. So let's start with transportation. The numbers I gave were the transportation data point and a US specific data point. So in the US, there's two programs in place. You can see under transportation on this slide, the RFS. So that's the Renewable Fuel Standard. It operates at the federal level in the US. That produces RIN credits. Obligated parties, who are those that sell diesel fuel and gasoline, they're obligated under the law to have a growing amount of renewable content, and they get that by way of these RIN credits that they have to purchase. That comes from all sorts of different low carbon fuels. It could be ethanol, it could be renewable diesel, it could be renewable natural gas. Renewable natural gas provides the deepest carbon cuts, and that's why it's highly sought after and highly valuable. You can layer on top of the RFS, the LCFS, the Low Carbon Fuel Standard. That's started in California about 15 years ago, not quite 15 years ago. It's in Oregon. Washington State is launching their program. British Columbia has one. We'll see a Canadian-wide one in the CFS here shortly. Then there's the European version of that. It's called RED. They just launched RED2 last year. That's set to replicate the same successful dynamics that we've seen in the US market with the RFS. So these are programs they have to highlight. They're not subsidies. It's market driven. It's a marketplace that basically just lays the guidelines and the guideposts that says if you're going to deliver fossil-based liquid fuels, you have to have a growing renewable content, and RNG factors prominently in those programs. And you trade the credits. It's transparent. There's market pricing set for that. And it's spot based. Now, when we come to the natural gas utilities, it's a little bit different. So typically a project that I showed the picture of, it lasts maybe 20 years of life. And the gas utilities being long-term players, and also being their business model being fundamentally a threat because their end users, which are homes, businesses, and factories, they can all switch to electricity. And really, there's only one of two ways to power homes, factories, and businesses. It's either through the gas grid or it's through the electricity grid. So there is switching that can happen. The gas utilities, in order to preserve their customer base, they do need to decarbonize. That's a point of competition. And the gas utilities are prepared to sign up for 15 or 20-year offtake agreements, off-taking from the project, the renewable natural gas. They won't pay quite the same high prices on the spot market of the transportation, but being a 15 or 20-year contract with a highly rated gas utility makes a bankable project, and that satisfies many of the financing criteria of the projects themselves to developers and project owners.
With the natural gas utilities, those 20, 15, 75% sort of commitments to RNG, those are both sort of a social license thing. They say, hey, we're going to do this to be a greener, better company. And as well, do they have mandates at either the state or provincial or sort of federal level to do that? Or is it more of just being strategically green and setting out those milestones, objectives?
Yeah, that's a really important point, Martin. It's more than just a good, social participant. This is fundamental. The targets are set for a number of reasons. So one is they're being driven to it by their customers. They're being driven to it by their local governments. But most importantly, they're being driven to because if they don't do it, they're out of business. Quite frankly, we have places like British Columbia that have the electricity grid being essentially 95% non-emitting, which means that electricity is basically carbon free compared to the gas grid, which is not that. So if you're Fortis BC, in order for you to continue to enjoy a customer base, you have to have a decarbonized solution, and that's where RNG comes in. So working with the provincial government in British Columbia, that's where the Clean BC plan calls for 15% RNG in the gas grid network. Fortis BC operates, I think it's 95% of the network in British Columbia. So they're the major player here. And then they've bought in. They have totally oriented their business around that because that's what they see as the future. And they've gone a step further than everyone else and said by 2050 they anticipate being 75% RNG. So if you step back and think about that, I mean, these are enormous volumes of renewable natural gas that need to be sourced. And FortisBC is arguably the most aggressive in North America. SoCalGas is another great example where they've got a 20% RNG target by 2030. That fits within the California overarching greenhouse gas mechanism, which is all codified. And again, it's all about driving decarbonization in these energy systems. So that's where SoCalGas comes from. Northwest Natural in Oregon, again, another very aggressive utility sourcing RNG from all over North America, the same as Fortis and SoCal are doing. That they've got some aggressive targets as well. So hopefully that answers your question, Martin, and that is an important question as to why would the natural gas utilities bother? It's well beyond just looking good and looking greener. If they don't, then their customers will switch. It's really that simple.
All right. And sorry, back to the transportation side. So just crudely, the government sets a standard 10% has to be a renewable fuel of the fuel they use. If they don't actually have it within their ecosystem, then they just buy the credits from other people who are producing it or using it. And it's kind of like a carbon credit, but it's an open market where if you can't buy it directly, you buy the credits on the market, and the market pricing prevails on that.
Yeah, that's exactly right. It's just another commodity in the commodities market trading. So the same, normally the big players that trade large volumes of natural gas, they trade large volumes of RIN and LCFS credits. So think of the usual suspects like BP and Shell. They all have their trading desks and they trade these environmental attributes as well.
All right.
Okay, so we skipped over this slide, and this one's important. This is the overall addressable market opportunity here. This is third-party data. There's some well-respected reports on Energy Outlook that come out every fall. This particular one is from IEA, based in France. BP does a really good one as well that's respected in the industry. They're similar results. And they do different scenarios. Up until recently, renewable natural gas wasn't even mentioned in the reports. A few years ago, they started recognizing the importance of it, hydrogen, and some other sources. So this shows a couple scenarios, but by 2050, ramping up to the numbers shown, which are basically equivalent to roughly 4 or 5% of today's global natural gas consumption levels, which doesn't sound like a lot, but at a global level, it's a lot. So to build out the biogas upgrading capacity to that level over the next 30 years equates to 90 billion in biogas upgrading equipment sales. So over this decade, that's over 20% CAGR for a 10-year period, which is phenomenal growth. And as I mentioned off the top, we grew 146% revenue 2021 over 2020. It was 100% revenue growth the year over year prior to that. So we're certainly, we think we're outpacing the market right now. That's our ambition. That's why we've set up Greenlane as a pure play and also established ourselves to be unique with the multi-technology approach, which I'll come to shortly. But before I do, let's explore just a little bit further those two market segments of transportation and the gas grid. So I mentioned some of these big players already. The oil and gas super majors have clearly moved into the space, which is fantastic. They're our customer set. They bring large amounts of investment. They want to own projects, but most importantly, they want to take advantage of the offtake, either for their internal needs or really just for their trading desks, because they'll trade it. They'll make some good money on it, trade it to whoever needs it, including themselves. Then we have some end user examples. We have Amazon, who obviously has a tremendous footprint around distribution and their own fleet. So a recent order from them, 1,000 renewable natural gas trucks for the US market, another 1,000 for the European market, all associated with long-term renewable natural gas contracts. They used to be called natural gas vehicles, but now they're called renewable natural gas vehicles. And that's because the market has Of that installed base of commercial natural gas vehicles out there in places like the US that started a couple decades ago, though that installed base of vehicles is now more than 50% fueled with renewable natural gas. So again, if you were to say, wow, if the diesel market had more than 50% renewable content, that would be absolutely amazing. The fact that that's happened in the natural gas sector of commercial transportation, which is the number one alternative to diesel fuel, that shows the success and the uptake that renewable natural gas has had. Clean Energy, they have the largest footprint in terms of fueling stations for natural gas stations, and they've rapidly been converting everything to renewable natural gas, where they've said that by 2025, their entire 550 plus fueling stations across the US will be distributing solely renewable natural gas. And it's beyond trucking. So C-SPAN is a Canadian marine company. They're already using renewable natural gas in their marine fleet, which has commercial ferry operations off the coast of British Columbia. So all the super majors are in. We've announced relationships with some of them. Some have remained nameless, but this is a strong customer set for us. Okay, let's talk a little bit about the technology. And I mentioned that the Greenlane is unique in the space and that we offer three of the main biogas upgrading technologies. Why do we do that? Well, we've done that because we've said Greenlane's going to solely focus on renewable natural gas. We think that's the big opportunity, 90 billion worth of upgrading system sales. And like anything, there is a selection to be made. All of these technologies, they do things slightly differently. They excel in slightly different ways. Greenlane was started the first to commercialize water wash. So that's been our portfolio since the beginning, 30 plus years ago. Then we added pressure swing absorption, and then lastly, membrane separation to the portfolio. And they're slightly different in the way they operate. At their core, they all do this process of separating carbon dioxide from biomethane. When we sell a system on a contract value, if it's a single system, it's somewhere between 2 and 12 million on a contract value, depending on the size and scope of supply. Pardon me. And then we often sell multiples. So many of our contracts would be, for example, a farm cluster that there's 3 or 4 farm sites, and they all need their own upgrading system at those sites, but it's done under one contract.
So, Brad, just on that, you said $2 to $12 million. The membrane separation is best for smaller. So a basic membrane separation would cost about $2 million, and a basic water wash, which seems to be the bigger one, would be like a $12 million project, and PSA in between that, or?
This is a bit oversimplified, but yes and no, I guess, is the way to answer that question. So water wash, yes, it does lend itself to the bigger projects, and we tend to see higher contract values when we sell water wash. However, we have some smaller sizes of water wash and some bigger sizes of membrane. So there's always exceptions to the rule, but this is the general principle, and that's what this slide is trying to again, a bit oversimplification, but to show where these things generally slide in the way that we think about projects where we have smaller ones, we have bigger ones in terms of flow. So that's one core distinction that would guide you into one type of technology or another. The other key distinguishing factor is what's the source of the biogas? Does it come from a digester or does it come from a landfill? That matters because it has oxygen and nitrogen in it. If it's from a landfill, that's because air gets ingested. It's really hard to remove that. So that drives you into a slightly different technology solution. It typically involves a PSA, which lends itself to removing those kind of impurities. And then the last thing that has a big influence is the output. So there's the pipeline specification, which one might think is uniform, but it's far from it. So every pipeline has its own specification that drives the technology selection. So between the flow size, the source of the biogas, and the requirements of the resulting biomethane, that drives the technology selection. And that's why We have multiple technologies in our portfolio. It's real simple. We didn't want to have debates with our customers as to why our one technology works. We said, well, let's just bring the most compelling technologies to the table and work with our customers on the selection to optimize their project. And that's been a highly successful model for us, and why we've retained market leadership.
Brad, sorry, you mentioned that these are the three main technologies in the industry. So it sounds like there are some other ones. Are you happy with this portfolio of technology, or would it make sense that some of these other more niche technologies you could buy into that or acquire some of that technology as part of your portfolio?
Yeah, so there's 5 in total. These are the reason this is the ones that we offer. They're the most popular and the most deployed globally. The 2 that aren't shown are cryogenics. Cryogenics for this size, typical of biogas, tends not to be cost effective. So that's why we don't offer that, and it's not really well sold in the marketplace. And then the other one is chemical scrubbing, which is very similar to water wash. Instead of using pure water, it uses a chemical. And so we've opted for water because that tends to be what our clients want, is a benign, environmentally friendly working fluid.
All right.
Okay, AirDep. So AirDep is an Italian-based company that we purchased, and we completed that deal in February of this year. The reason we did this is because every biogas project has hydrogen sulfide associated with it. It's a key element of what we sell in our systems today. So, these images you can see in the highlights in blue. So all of the systems use some form of hydrogen sulfide removal. We came across AirDep some time ago and felt that the technology that they were selling was compelling, particularly for higher flow, higher H2S concentration applications, and offered great price performance, offering lower capital costs and operating costs than some of the competing methods. So we felt that because it's so core to what we do, so in addition to the core of the separating technologies, these ancillary parts add tremendous value in what we offer, and to firm up our IP position, we felt that a business combination was the right thing. So we completed that deal. AirDep had provided over 100 of these desulfurization systems, over 10 years of experience, so a real market leader in the space. Most of those were in Italy. So there was the other dynamic here, was to take this relatively undiscovered technology that's had great success in the Italian market, take it global, and embed it firmly into our system sales. So that's the underlying rationale. AirDep also offers an extensive line of air deodorization products, but most of what they do is biogas desulfurization.
And is there, so is there specifically for biogas desulfurization? They don't work in like traditional gas fields or anything like that? Or could you explain their existing or traditional end markets?
Yeah, that's a good question as well. So gas desulfurization generally, obviously that's done all day long, every day in the oil and gas space. There are some similarities, there are some commonalities, but for biogas specifically, it's quite unique. The cost profile is different, and the equipment's slightly different. So yes, there's learnings that have been captured from the oil and gas space, but the products have to be tailored specific for biogas, and that's what AirDep has done, and that's why it was a great fit for Greenlane, given that we're all in on biogas and not on oil and gas.
When you had your 100 plus prior projects and that desulfurization is core to it, were you the one speccing in that desulfurization technology into your projects? And had you worked with AirDep a lot in the past, or did the end user decide on what kind of desulfurization equipment to use?
Yeah, the dynamic there is generally it would be part of our scope, and we would buy it out from a third party. Sometimes our customer, whether that customer be an EPC company, they might take that into their scope. So we felt that by having it within our scope, that would tend to drive our scope, providing the full end-to-end, we call it flange to flange system that includes the H2S treatment, and that's one of the underlying rationales. So the obvious piece there is margin improvement and improved price performance on the overall upgrading system if this key element was internal to Greenlane.
Given that for the most part you incorporated it and you were buying third-party stuff, I presume that had kind of lower margins on it. Is having this in-house, is that going to increase the average gross margin on your project since more of it's your technology now?
Yeah, that's the principle, is that it's some margin improvement and price improvement. And then you can see, obviously, it's a subset of the overall system. So there's other things that do drive margins. So that will, help. And again, that's one of the underlying rationales as to why we did that, was for that margin improvement and price performance improvement.
All right, thank you.
Okay. I think I mentioned this already. So over 135 systems, biogas upgrading systems. So globally, 100 of the hydrogen sulfide mostly into Italy. 19 countries, 12 of those we were the first. Again, a real pioneer, and many of the largest projects in the world. I'm not going to spend a ton of time on this, but some of the largest. Montreal landfill is one of the largest projects in the world. We did that one. Güstrow, Germany is a crop-based project that was done about 10 years ago or so. So those are some of the biggest, and those particular ones used water wash. Some difficult projects that we did, that's one of our calling cards as well. We were the first to provide a commercial scale biogas upgrading system for the state of California, who at the time we did this had something called Rule 30. They still have Rule 30, but it's a softened version of it. It was much more stringent, arguably the most stringent pipeline spec in the world. We met it, but most importantly, we worked with them to help relax the spec to make the systems more economically viable, and that factored into SoCalGas's target of 20% RNG by 2030. So we're proud to be part of that space, and much of what we do is in California, or serving California. LNG is an important one, especially in Europe. LNG is the preferred fuel, so liquefied versus compressed for trucks. So typically in North America, we see compressed. Typically in Europe, we see liquefied. To make a biogas upgrading system work together with a liquefier, there's some special steps and considerations that have to happen. So we've done those as well, and shown our capabilities. In terms of what's inside the company versus out, we have a fully outsourced manufacturing model, asset light, which means that we source globally for components. We have select trusted manufacturing partners for key elements. We don't have an over-reliance on any one particular supply chain partner. That's deliberate. And it's globally distributed, because our customers are globally distributed. In some cases, there's some large equipment moving around. Delivery time is a point of competition. So again, that's why we have a distributed supply chain, not just for de-risking, but to make sure that we've got the best price, best delivery factors into this as well.
Do you do any sort of final assembly, or your manufacturing partners do the whole thing and then ship it to site, and then you contract out to people to do the final assembly and installation on site?
Yeah, so the way it works is all at the system level, it's all our design, all our specifications. So everything's made to our spec. We have third-party fabricators make it when it's at a skid or containerized level. We do the sourcing of the components ourselves, because those are our specification. And then the equipment gets shipped to site. So back here, you can see, if you look at the middle slide, is a nice, helpful one. There's roughly 5 modules that show up to site. There's interconnections that have to be made, and that's typically done by a EPC company that's hired by the client. And then we'll come in, send our commissioning engineers, do the commissioning and performance testing, and then hand over to the customer and have an ongoing maintenance and service contract over time. So, and that's with a 24/7 remote monitoring and field support.
And it's too easy of a question, but you got to ask it in terms of global supply chain issues here, which has been so prominent in the news. How has your global network helped or hindered that, or how is? Can you discuss that a little bit?
Yeah, I mean that's definitely a talking point for sure. It's I can honestly say it hasn't been easy. We've had to navigate a number of challenging situations with some bit of chaos in global shipping. But the short version is it's fair to say that it's helped, not hindered, having the flexibility of different suppliers around the world. That was very helpful rather than having one factory that serves global customers, because then you're pretty much locked in. So we've have I'd say it's definitely worked out for us. It hasn't been easy. It's taken a lot of attention, but yeah, so far so good. It hasn't materially delayed, most of our projects. So I can't say that for many of our competitors. They've had some real challenges.
And then on the other big headline news is on the inflation. When you bid on a project, do you lock in all the commodity costs right away, so it hasn't really impacted you a bit, or how has inflation been hitting your projects?
Yeah, I'd say from an inflation perspective is typically the way we work is because it's an ongoing process and dialogue with our supply chain partners who are part of the sales process insofar as when we're working with a customer and we're getting close to securing an next contract sale, we'll simultaneously be working with our supply chain partners to lock in pricing there, such that essentially the day we contract with our customer, we're contracting with our key supply chain partners so that we aren't sitting in the middle holding the bag on some sort of inflationary impact. So that's been a successful strategy for us. There's maybe a few parts, some labor on site, some loose components, but in the big picture, those are small relative to the overall contract value and don't swing largely the overall margin performance for us. And I think, if you look back at our margin performance, we've done quite well. We've been very consistent in and around the 25% gross margin level with small variability. So that's reflective of our ability to execute on both supply chain challenges as well as any sort of inflationary impact.
All right.
Competitive landscape. So what do we see? This is cumulative. So this is biogas deployments over time. The different technology types. I mentioned that there was 5. You can see 4 of them here. I mentioned that the cryogenics typically isn't used, and that's true. So Greenlane being unique, offering multiple water wash, PSA, and membrane, and a few competitors offering different flavors. Air Liquide's probably our number one competitor. I'd say it's mostly in the U.S., well-recognized name. People often ask, how do we compete against someone like an Air Liquide when they're big and we're small? Well, that's exactly how we compete. We're small and they're big. So that tends to mean we're much more dynamic, fast-moving, and able to have points of competition that really outpace them. And I think a lot of our customers appreciate that. But also because we've been around for so long, we've established a strong track record. As most industries, there's some conservatism, and people want to work with a market leader and someone that they know knows what they're doing. And Greenlane's been able to establish that position in the marketplace. And there's some big names. There's Air Liquide, there's Wärtsilä, who's a large ship maker or ship engine maker in Scandinavia, and a few others in the space. So. Okay, deployment of development capital. So this is a program that we formally started last year, and it's really exciting for us. And what it is, it's to add recurring revenue and profits to our core business of selling the systems by adding some exposure to the lucrative RNG offtake contracts. And we do that by working with developers who are pre-construction. So this is before the construction finance, where you need development capital, which is higher risk. No doubt, smaller quantum. So we deploy the capital to accelerate the project to the ready for construction phase when project finance comes in. That secures the Greenlane system sales and service into the contract. That's a prerequisite for deploying this capital. And it gets us a small equity or profits interest in the resulting project that over that project life of 15 to 20 years, it provides revenue back to Greenlane. So our vision's not to really become a build own operate company. That's not it at all. So we don't want to own 100% of realistically a limited number of projects that we could develop our own, but rather have a platform out there that we can work with what is a large and fragmented community of developers who, could all benefit, not all of them, but a good portion of them could benefit from development capital that they don't necessarily have access to, because if you think of the kind of things that they do, the nature of that is not bankable. So we're prepared to take a risk position and have a high return on that first in money on these projects, and help the developer help us by specifying our equipment, and then get a small portion of a large number of projects into which we've sold equipment and get a profits and equity position.
Brad, could you just walk me through, like, I guess the you've only announced one of these deals to date, correct? Could you just walk me through at what point does the developer contact you and say, hey, we're interested in some development capital, and then sort of walk me through the steps? And then when it goes into the construction phase, do you get some of the capital back and there's a bit of a retainer there? Just give me a clear example of how it would work.
Yeah, so just flipping back to this ecosystem slide, this is the end result. This is what you want an ultimate project to look like. If it's a landfill, the landfill has to provide the biogas to some place. There's an upgrader there. It has to have a connection into a local pipeline. So that's what it needs to look like at the end. But at the beginning, this is all white space. So someone has to do some work to get the feedstock contracts, to get the secure the site into where the equipment's going to go, get the contracts for the construction, get the pipeline interconnects. So that's the piece of work that we're funding with this program. When it comes to actual construction and placing the orders for the equipment, the Greenlane, for example, that's construction finance. So that's out of scope of our development finance. So that's why we talk about three distinct phases. We talk about the development phase, pre-construction, the construction phase, and then the operating phase of the project. So the last phase is what we're looking at on this chart. And so that's the general theme. The developer is usually the one that has the contract or the relationships with the local feedstock provider, access to land, and the relationship with the local pipeline company. It's an inherently local activity, and that's why we've created this program to work with these folks that are local, and you need that local work, and they need the money.
And typically, how much money? So they secure the basics, the land and the relationships and so forth. Then they go looking for development capital. They talk to you, and then with that, you're going to design the plans, get all the offtake agreements and so forth. And you design the whole thing. They win the project, and then does your capital stay in at that point, or does it kind of get replaced with the construction capital at that point? Like how long does your capital get deployed for?
Yep, great question. So we announced our first deal just a couple of weeks ago, and that was just under $1 million US. And just to give you an order of magnitude, a construction capital would be an order of magnitude, more than that. So if it's, just loose numbers, if it's $1 million of development and say 20 or 30 million for the construction finance, that's the quantum that we're talking about for the development capital. We would expect to have a return on the principal either at the front or no later than the end of construction. And then to have, another, call it, 1x-ish return over the life of the project. So that's because it's first money in, a 2x return on that capital is market. Whereas if you're investing at the project level as a construction finance investor or, the ultimate project finance, you might expect an IRR something in the teens or maybe mid or high teens kind of level. So that's why we've selected, for a number of reasons, is the development capital. It's a high return. It's synergistic with our customers. We don't compete with our customers. And we're really well placed with our background and understanding of biogas projects to assess the risk, more so than a pure financial player when it comes to development capital.
So if you write a check for a development project for $1 million, you would get that $1 million back in what, 12, 24 months, and then you would have an ongoing residual from your equity ownership over the next 15 years or so from that. Are those rough numbers okay?
Yeah, that's perfect. Yeah, construction would take somewhere between 12 and 24 months is a good proxy for that. And yeah, that's right. So we get, the principal back within that time frame, and then over the 15 or 20-year project life. And it's not limited to 2x. It depends on how well the project does and its revenue stream.
And it sounds like from that you'd probably get $10 to $15 million of equipment sales out of that as well on that sort of scale where we've used as an example.
Yeah, depending on the project size, if it's a 20 million project investment, for us, it would be, the rule of thumb is it's between 10 and 20% would come for the biogas upgrading equipment if it involves a digester. If it's a landfill, it might be closer to 50% of the project cost. So in other words, if it's a 20 million landfill project, maybe 10 million in biogas upgrading equipment, roughly. And if it's a 20 million digester-based project, like at a farm site, that might be somewhere between, maybe roughly 2 or 4 million in biogas upgrading equipment sale contract.
Gotcha. All right, cool. Thank you.
Okay. Good. How are we doing for time, Martin?
We're good. We should we're going. I'm okay. We will probably not go too much longer, but this is a lot of great information here. So,
well, I just have the financials to hit quickly, and then we can open up for questions. So I mentioned the growth rates already. We don't need to rehash that. We did announce our quarter ending March 31st. So revenue was strong, our second strongest quarter on record, 16 million. Again, gross margins, I mentioned it's been very consistent for us over the last many quarters, 25% again. Positive adjusted EBITDA, although in Q1 it was pretty much a break-even quarter. That's an important point to touch on. As we continue to grow, we are conquesting. This is early days in this space. We are continuing to reinvest in market expansion, staking out our claim in new market territories. I didn't even talk about markets like Brazil. We are a leader in Brazil, market leader in Brazil. We do intend to invest in that market space to keep our leadership position. And a contract we won last year, for example, was the first in Colombia. So opening up a new market, yet another country. So those are the kinds of things that we're reinvesting in, as well as our products to make sure that they continue to be attractive, because right now is not the time to harvest the business. So it's really our core metric is revenue growth in the business. Gross margins is a very important metric that we keep an eye on, and then reinvest prudently with the ambition of being adjusted EBITDA positive.
So just to clarify what I think was actually kind of pretty obvious, you're not focused on maximizing EBITDA at this point. You're still investing in growth, opening new sales offices and business development stuff. I guess you're trying to be kind of EBITDA positive, but that's not the main driving is like economic or sustainable growth. So you're not blowing your brains out trying to grow the business. That's
precisely right. We know that if we focus on these fundamentals at this point in time, then the EBITDA growth will take care of itself in the future years. If the flip side of that, if we focused on maximizing EBITDA right now, we'll clip our wings from a revenue perspective, which obviously is going to hurt EBITDA on an absolute basis in future years. So right now is the time to make hay while the sun's shining in terms of conquesting. I mixed many metaphors, and I promise not to do that again. But that's our strategy as of right now. I think it's been working for us, and just reinvesting prudently on the EBITDA line. The other thing I should highlight is cash balance. It's strong, 23 million in the bank, no debt, which is a great position to be. Very clean cap table. We'll go through that in great detail. Insider ownership around 12%. Our staff, which I think we're running out of time to talk about, And then maybe I'll leave it there. But maybe just quickly go back and do the reminders, and then we'll open up for questions. So rapidly growing space. We are pure play in it. 146% annual revenue growth year over year, 2021 over 20, with 100% prior to that. We are the largest global supply capacity in the industry, strong sales order backlog and pipeline. Our core business provides consistent and healthy gross margins. We have expanded now into this recurring revenue and profits model with our deployment of development capital. We've announced our first deal just some weeks ago. We've got many more in the pipeline. We've had great response in the industry to that. We're unique in that we're the only ones to provide the 3 of the main 5 upgrading technologies. We're looking at $90 billion over the next 30 years in terms of the total market opportunity for biogas equipment sales, and there is significant demand. Let's talk just before we open up for questions, because that's exactly where you started this, Martin, has anything changed in the core business? And the answer is really no. So this market demand hasn't gone anywhere. It doesn't appear to be reflective in the share price, but the basic demand for low carbon and carbon negative energy for commercial transportation and the gas grid, that hasn't subsided. So maybe some of that's happening in the background from an investor's perspective. It's as strong as ever. We're working towards net zero. Basically, net zero is the mantra for everybody by 2050. And we've got a lot of decarbonization in front of us. And so that's still what we're facing today. So the fundamentals are strong. As I said, I could have just said that and saved all the words in between.
All right. A couple questions here. Cost of natural gas going up, the price of natural gas going up is a benefit to you. I presume it makes your economics better. But conversely, over the last little while, the price of money through interest rates has gone up as well. Are you seeing that change in interest rates? Could you talk about that dynamic in terms of the projects going forward? Does that create new projects or put any of your pipeline at risk, given how things have changed so dramatically this year?
Yeah, so there's two elements you referred to. So one's the commodity price of the physical commodity, the natural gas itself. So let's just use that dairy project example, $100 per MMBTU. 95% of that's the environmental attributes. So yes, it's helpful. But think Europe. I mean, TTF in Europe has skyrocketed, and that's become a much more substantial part, maybe a third or more of the overall price of biomethane in Europe. In North America, we haven't quite seen the same escalation, but it helps, is the point. In terms of the cost of money, it depends on who is the ultimate project owner. So if it's one of the oil and gas super majors, how much debt they load on is their call, but typically that's not an issue for any of them right now in terms of the rest of the capital investment profile they have across their businesses. So to take a full equity position, deploying their capital for construction finance, and whether they put debt on top or not. Again, we're not seeing huge swings in the debt lending rate right now that are going to factor large into this. And then lastly, I'll answer the question before it gets asked, is how many of our customers need to go back to the market to raise money to fund their projects? I'd say a small set of our customers, because most of our customers, especially now with the entrance of the oil and gas super majors and many of the end customers being the gas utilities, and also a third category are funds that they typically have their underwriters, which it's not a public market mechanism, but they've got these billion-dollar funds they're looking to deploy. None of those have to go back to the market to raise capital to build out the projects. So that's kind of where we sit right now, and it's so I'd say that the capital markets, the dynamic we're seeing today hasn't really negatively impacted what we're seeing in terms of order flow.
Your backlog is huge at like 900, or your pipeline is huge at $900 million, and your backlog is what, 35, 36, I believe it was. When that funnels down, some of those projects, I guess, just die on the vine. They can't get capital, or something goes haywire with it. You lose some to competitors, and then when your seemingly fair share. Could you just talk about how that funnel works? Because that's a big funnel you got ahead of you. How much do you expect to sort of fall into the backlog?
Yeah, that's a great way to describe it, because that's exactly what it is. And the thing I can add to that is that 900 million is typically a 2-year visibility. So, beyond 2 years, we don't have great visibility, because you can imagine the development cycle is only so long, and that's dynamic. So projects, come in, they go away. Maybe they weren't viable or for whatever reason. So we could have sitting in that 900 million number, we could, announce an order next week, and then that'll take out of that 900 million number. And then as we get new discussions going with developers, then we'll add into that number. So in terms of, what we see in our backlog has been, it's between, we've had as high as 50 million in some recent quarters. It does fluctuate, right? Because it depends on the date when you get the order. So if you get the order March 30th versus, April 5th, it'll show up in your Q1 numbers, and we announce our backlog just at the end of every quarter. So, the same way that your working capital fluctuates, then our backlog number fluctuates, but it's in and around that range, but growing en masse. So we don't really, I can't say like it's 5% of it or 10% of that. That's not really the right metric. But the way to think about it is, provided that it's significantly above where our current backlog level is, then that gives us ample opportunity to funnel down the most promising opportunities in that 900 million number.
All right. Some additional questions here. Does Greenlane plan to pay a dividend within the next 4 or 5 years?
Or 5 years? That's an eternity. That's a long way.
Yeah.
Good question. We haven't really got to that point yet. I can say right now, in the short term, there's no dividend planning right now. But 4 or 5 years from now, who knows? That's a decision that we'll take in the coming years.
All right. Will there be more of a concerted effort to access U.S. investment and institutional community going forward? And I guess there's often these questions as well of like an ASDAQ listing and all that path to get closer to the U.S. markets.
Yeah, that's obviously something that we pay close attention to, and at the right time that can make a lot of sense. I think right now with the state of the markets, today or tomorrow is not the right time. And there's certain listing requirements that you need to do to do that. But certainly, we've been active in the U.S. markets as a TSX listed stock, so U.S. investors can buy. We've been actively in front of them, but a NASDAQ listing or something like that is certainly sitting on our radar. But it's certainly I'd call it back burner right now.
Yeah. About more M&A, is there an opportunity for more M&A with sort of adjunct technology, or maybe consolidate the industry by some of your smaller competitors out there?
Yeah, those are exactly the two buckets. There's the add-on technology like we did with AirDep, or purchase a smaller competitor. Both of those are where our M&A focus is. And to answer the question, yes, we're still active on that file. We have a number in the pipeline, and we've just done our first one, and it won't be our last one.
With that first one, how much integration is there with it into the Greenlane system? Like, are they manufacturing their own equipment and you're going to transition them to be a more of an outsourced provider like yourself, or do the teams have to merge together? Or are they more kind of like a standalone operating entity with sort of a little bit outside of Greenlane?
Yeah, there's two components to that. So firstly, standalone, they make a specific discrete component that fits into our overall system. So in that perspective, they can operate relatively standalone. But the other strategic rationale for this was to establish for Greenlane a footprint in Italy, which has many things going for it. One is it's a dynamic biomethane market from an end user perspective and a customer perspective. And then on the supply chain, that part of Italy is rich in cost-effective highly qualified suppliers. So, in my past life, I've certainly done enough deals in that part of Italy to know that, and they have a real propensity and competency in gas handling, and they do it really well. So we will build out over time, take advantage of that footprint in Vicenza, and build out our biogas upgrading component. So that currently doesn't exist in that part of the business, but that gives us the possibilities.
All right. When can we expect a new CFO?
Oh, very soon. Very soon. So we said, we're unfortunately losing Linda. She's been absolutely fantastic. We're in the very late stages of that process. So, watch this space. That we said Linda was going to disappear at the end of this quarter, which is now fast approaching. So expect to see something from us soon on that topic.
Gotcha. And the final question here, and we're into an hour here, so this is a good place to end. We'll end on a bit of arm waving here. Do you believe that you are a takeout target?
Let's see. How do I answer that? I guess possibly. I mean, that's not really how we're structuring the business. We're not building it to be taken out. We're building it to be, if anything, the takeout. So that's our M&A strategy, is that we think that we've put a compelling platform together to consolidate other companies in the industry. But who knows? You never say never. And if someone wants to look at us and take us out, maybe that's going to happen. But that's certainly not what we aspire to have happen.
All right. And I like wrapping up these conversations with an outlook for the remainder of the year in terms of what kind of news flow. You just did an M&A, so I'm guessing you probably shouldn't be expecting bit of digestion time for you guys on that. So maybe not something too soon on that. Announcements of larger contracts, more capital deployments with your capital group. Is that the type of news flow, or anything else? Invest, and as well, obviously, a CFO. What kind of news flow should we be keeping our eyes open for?
Yeah, so obviously the CFO is probably going to be the next one. But the basic ones for us that are good guideposts for our business is just deal flow on the customer side. So announcing new system orders. Now that we've announced our first deployment of development capital, we're just getting going on that. We've got traction, great response in the market, so expect to see more there. And then you're right that on the M&A side, that's not going to be a frequent announcement, but expect to see more from us on that over time. So those are the three main areas that are good catalysts for our business.
All right, Brad, thanks a lot for taking the time. Very great update. Glad to see things are going well there, despite what's going on in the market. So thank you very much, and great talking to you again.
Yeah, and thanks for having us back, Martin, and it was a pleasure. So
cheers
so much. All right.